Good morning and welcome to this Wednesday, April 7th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, the market wasn't too bad on Tuesday. I mean, we did see a little bit of a pullback on the Dow and S&P and NASDAQ. But I mean, when you consider, where we've come from recently and the nice start that we've had to April, not too bad. And mid caps actually squeaked out a small gain yesterday, but we'll get into all that in just a couple of minutes. As far as this morning goes, I mean, still, maybe just slight move to the downside is what we're looking at. Right now, the Dow futures down 44, S&P down 5, Nas futures down about 26. So a little bit more weakness on the Nasdaq on a relative basis, but the Nasdaq has been trying to make up some ground of late on a relative basis. So we'll go ahead and get into that in just a minute. But for those of you that are new to Earnings Beats, let me take you over to earningsbeats.com and at least make you aware of our free Earnings Beats Digest newsletter. Simply type in your name, email address, hit the subscribe button, and you will start receiving our newsletter, which is published 3 times a week, Mondays, Wednesdays, and Fridays. We try to get it out before the stock market opens. So normally 8:30, 9 o'clock was kind of our target. Very educational in nature, trying to teach folks how we look at the market, giving some trading opportunities, and like I said, just providing education. Mostly it's concentrated on earnings and relative strength. Moving on, let's take a look at what happened on Tuesday. We had the Dow Jones Industrial Average, like I said, down almost 100 points, so about almost 0.3%. But this comes on the heels of a pretty nice breakout above 33,000 to start the month. We're in all-time record high territory across most of our indices, or have been in 2021. All of our indices have set all-time highs in 2021, even though we are seeing a little bit of rotation, especially in that NASDAQ. You can see that ABC correction. And, when folks look at the market, they, a lot of times I hear, well, I don't want to get in because the market's gone up too much. And therefore, I'll just wait until the market pulls back. Well, the entire market, when you're in a secular bull market advance like this, you're probably going to struggle to find the entire market pulling back. More likely is what we saw with technology. Technology takes a break for a month, 6 weeks or whatever, but the overall market continues to go higher even without technology. And it was interesting because, a year ago when a lot of the big large cap tech stocks were moving higher, everyone was saying, well, this isn't a healthy advance, because it's just the large cap tech stocks that are leading. And now you've got the market moving up without that leadership. Now, recently they're starting to come back, but for a month and a half, the market was moving up. And then I read some articles that were saying, well, you can't trust this move because, some of the leaders aren't participating. It's, there's always something about the market that doesn't look good. You just have to understand from a long-term perspective, the stock market wants to go higher. The fundamentals certainly suggest we're going to go higher. I mean, GDP 6.5%, 7% in a 1.7% environment on the 10-year Treasury yield. I mean, that's really nirvana for equities. And when you think about it, what's the alternative? And that's really what's driving it as much as anything. I mean, the fundamentals are great. Earnings growth has been fantastic on many companies, and it's going to strengthen significantly on others, which is why we're seeing some catch up. But, when you just think about what's going on in the marketplace and, what your alternatives are to investing in the stock market, you look at the S&P 500 just on this chart, we're up near 4,100 now. 3 months ago, 3,700. So let's just say 10% in 3 or 4 months. Look at your alternatives. Okay, I can put my money away for, every year earn 1.7% on a 10-year Treasury yield, or I can be in the stock market where I just made 10% in 3 or 4 months. And portfolio managers are being evaluated based on their performance. And so there's pressure to move out of some of those more defensive areas. There's a lot of folks that are saying, hey, why are you making 6% a year for me when the S&P 500 is going up 15% a year? or 20%. Well, the last year's been better than that. So that's a real life problem that portfolio managers deal with and have to eventually, come to grips with. And so that's what we're seeing. We're seeing a lot of money rotating out of the bond market, driving stock prices even higher. I mean, at the end of the day, the stock market is simply demand and supply. That's what it comes down to. So if you've got billions of dollars pouring out of the bond market that want to go into stocks, that's going to lift the prices. And I mean, we can sit back and fight it all we want, but that's the way the whole rotation, asset class rotation works. And then within the stock market, you have sector rotation, industry rotation. And that's what I was referring to with the NASDAQ. So anyhow, mid caps, you can see, did try to make a breakout yesterday and failed, but that's a really nice pattern, uptrend. It's kind of a V, but you can almost look at it like a cup. So if we did pull back here in the near term, I think that's very healthy for mid caps. Small caps, not as strong on this bounce back, haven't gotten back up to that high that we saw in March. So just looking at this chart, I can see money rotating away from small caps and into mid caps. Just looking at the recent highs, you can see mid caps are right back where they were a month ago or 4 weeks ago, 3 weeks ago. Small caps are not. And you can do that with, and then you can see, look, NASDAQ from that high went up. S&P has gone up. The Dow has gone up. So we're seeing money still rotating back away from mid caps and small caps more toward the larger cap stocks right now. Will that continue? I don't know. I don't believe so. I think eventually we're going to see the small caps leading again, especially in this kind of an environment. They can grow their earnings much faster than large companies. So they're going to command higher multiples, in my opinion. Moving on to the sectors, utilities, discretionary, staples, communication services. Those were your 4 leaders on Tuesday, led by the utilities. But look at the percentages. I mean, 0.53%, 4.3, 4.2, 2.5. I mean, it wasn't that much difference, but still noteworthy to see 2 of the 3 top groups being defensive. Maybe market getting a little defensive after having a nice advance. Technology, after a huge move over the last week or so, pulled back and was the worst performer yesterday, but we are very close to a breakout, and I think it's coming on technology. And we talked about this going into earnings season. As you start moving toward earnings season, my feeling was that we would see money returning back toward those technology names, and I think that's exactly what we're seeing, and I think it's going to continue. Are we going to go up every day? Of course not, but I do suspect that technology is going to perform well over the next few weeks. That's what I would anticipate anyway. We'll see. All right, moving on, 10-year Treasury yield. Not really anything out today in terms of economic news. We do have the Fed FOMC minutes coming out at 2 o'clock today, so I'm sure folks will be scrutinizing that, see what the Fed had to say. Right now, we are up 1 basis point, not really doing much in the bond market, 1.67%. We have kind of pulled back. Watch this rising 20-day, because you can see that PPO is clearly rolled over now. We've talked about this really for the last 2-3 weeks, but as we've been setting these new highs, you can see that PPO rolling over. So I think this move higher in the yield is starting to lose momentum, has been losing momentum. And so a little bit more sideways consolidation, possibly even a breakdown below the 20-day. And if we see that, that could be fairly significant in the near term, because financials have had such a big run. You might see more selling in financials and more money rotating back toward technology with lower interest rates and with earnings season. Many of these big tech names reporting over the next 3-4 weeks. All right. What else do we have? Nothing really on the yields. Let's keep moving. I thought what I would do, this is a 3-month hourly chart, and I'm going to maybe try to make this just a little bit taller. But this is one chart that I like to look at just to see, what's kind of leading the market to the upside. So the top panel here is your S&P 500. And then each of the 5 panels below is one of the aggressive sectors divided by the S&P 500. So we can look at relative strength by doing this. So technology, consumer discretionary, communication services, and then the industrials and the financials. What I just wanted to point out is just over the last few days, you can see since mid-February, we saw weakness in technology on a relative basis. That's where technology paused. A little before that, back in early February, we saw that top in consumer discretionary. Now, consumer discretionary also put in a relative bottom sooner than technology. Technology stayed down near this relative low for a while and has just started to turn back up. Consumer discretionary has actually been performing pretty well now for a while, and we're at a roughly 6-week relative high right now on consumer discretionary relative to the S&P. So we're getting a nice bounce back in consumer discretionary, which again is something I would have anticipated. Communication services stayed strong throughout the period, really. We had just a few days where it was not good and then turned right back around, starting to move back up again. And then when you look at industrials and financials, you see almost mirror image that throughout February and March, this was the group that was leading. So you kind of see how that baton was being passed. So you've got technology and discretionary stocks doing well until we got into February, and then they start going down. But the other three aggressive groups pick up and lead. And that's why the overall market, even though the NASDAQ was hit pretty hard on a relative basis because of technology and consumer discretionary, they're starting to bounce back because those two areas, which represent quite a bit of the S&P 500, are starting to rebound. And then you see industrials and financials lagging and pulling back. So I just wanted to point that out because this is a chart that I like to follow quite often, just to kind of get, look under the hood, if you will, of the market. It's like, a car isn't running well or something, but you're outside and you're listening to it and it seems to be okay. I mean, you don't really notice anything going on, but if you're really sharp, you're a sharp mechanic and you flip the hood open, you might spot some things going on. So yeah, the car's still running nice, but there's a couple things going on that probably need some fixing. And that's what happens with market. It still sounds good. You're watching the chart and the S&P is going up, setting new highs. But when you look under the hood, you see some issues. And those two issues for a while were technology and consumer discretionary. But both of those now are starting to get a fix. And you can see technology on a relative basis now up at about a 1-month high relative to the S&P 500. So it's not just the chart. I mean, we could pull up the XLK and see that technology has been, moving up really nicely recently. But the overall market, the S&P 500 is breaking out. So just looking at this doesn't tell you the whole story. You want to see technology beginning to lead. Now, they haven't broken out. And I see, move up. Everyone was, all upset about this move to the downside. But I pointed out the inverse head and shoulders. So you got the left shoulder, neckline, inverse head, neckline, right shoulder, and breakout. That's one pattern. Another pattern that, some technicians would probably see is a little cup here now. If you're not a inverse head and shoulder fan, you look at this and you come down, you got this low, you got this low, you got this low, and see how you kind of got this rounded bottom? And all of a sudden we're right back up to that high in February. So, I see an inverse head and shoulder. I also see the cup, both patterns very bullish. They're bullish continuation patterns. And so what's lacking now is possibly we'll see a little pullback here, but a breakout. I mean, if we go through 140, I fully expect technology is going to begin leading. We're going to continue leading based on what we just looked at on the other chart here. So here's where technology is really starting to come back. If we break out, I expect this is going to continue to the upside. So this is what we want to watch. Now, why don't I just take a second here? I can update this pretty quick. So if I switch technology out to utilities and switch out consumer discretionary to staples, and then the XLC will go to healthcare, and the XLI will go to real estate, and then we'll just get rid of this last one and update this. This will give us the defensive groups. Now remember, going into March, defensive stocks generally lead during March. Here was the S&P 500, went up a little bit throughout March, definitely toward the second half. And utilities led during March, now starting to trend lower. Consumer staples led during March, now starting to trend lower. Healthcare just kind of flat, but now trending lower. Real estate led during March, now starting to trend lower. Honestly, what happened, and maybe to it was kind of like a rush to some of the defensive areas on steroids, maybe more so than what we normally would expect in March, but it really followed seasonal patterns and history. And I would be careful the third month of every calendar quarter, March, June, September, and December. If you've got some kind of a mechanical system, and that's still something that I'm trying to work on and perfect with earnings beats. But if you've got some kind of your own system going, I would at least consider the possibility of just becoming a little bit more defensive in the third month of every quarter, just because history tells us that you need to be a little careful. All right. So let's take a look at, we looked at technology. Let's look at discretionary. Just look at their absolute chart. See the breakout above that February high? So we're definitely seeing more relative strength in the discretionary area, and it's been accelerating. And now that we've got this breakout, I expect it will continue. I think what we went through is now behind us in terms of technology and discretionary, especially discretionary, because we've got the absolute price breakout. I think when we get that on technology, that would make me feel much better about the relative picture of these two groups. And these two groups, I would say, are my favorite two groups to lead during secular bull markets. So seeing discretionary stocks break out and seeing technology bounce back and try to break out, getting close now, to me, that's just makes me feel more bullish about where we could be headed in the near term. All right, let's see. One company that did raise guidance, and I've been watching for warnings, and I don't know if anyone else is seeing warnings, but I have really seen, I can't think of a big company, any kind of influential company that has warned going into earnings season. And I think that's very bullish, because the last couple of quarters, we've been seeing companies not only beat, but many raise guidance. And so if nobody's coming out and warning, that is, sometimes no news is good news. In that case, I think it is. So we've got companies that are willing to ride into earnings season with those prior forecasts. And I think that's a good sign that many of these companies are probably going to beat prior raised forecasts. And that, I think, in turn, starts to ratchet up those multiples on these stocks. Because if the earnings beat and they continue to provide solid guidance, and I can't imagine in an economy that's going to be strengthening the rest of the year that companies are going to be out warning about future quarters. I think they're going to beat, and I think they're going to raise. And when they raise, guess what? Valuation models start changing again. Because now all of a sudden this company, which was, you thought was going to grow 25% a year, just raised their forecast, and now you might be upping your model to growing 26 or 27% a year. And still, with rates very low historically, those future earnings rates that are being accelerated to the upside are still going to be discounted back at very, very low historical interest rates. And that's going to create high multiples. So I don't really see a lot changing in the market. I know we went through a pretty hefty correction and still in the midst of it. And some of, the stay-at-home stocks that did really well last year, many of those are still struggling on a relative basis, but they're starting to come back. And I think over the next few weeks, we're going to see them come back further. All right. I had something else I wanted to go over here before we get into a couple earnings. I wanted to look at the relative strength industry groups. So in technology, I'm going to go through these really quickly, but if you're unfamiliar, this is a 3-year relative chart. This is computer services. So this is within technology. So I want to go through the technology and the consumer discretionary industry groups with you, just to kind of give you a sense of what I'm seeing here in terms of relative strength. It's nice that they're going up. If you look at computer services, this is what you would look at if you saw the computer services chart. This is the absolute price action. So it's breaking out. So you might look at this and say, man, I'm in a great area. I'm in computer services. It's moving up to an all-time high. This is great. And then you look at the relative chart And you realize that the only reason it's breaking out to a new high is that the overall market's on fire. So it's a rising tide lifting all boats. Computer services is not a strong group. Look at the relative strength. It's been going down for 3 years. We had this one little nice, 8-month move back to the upside, but for the most part, we're just trending lower and lower and lower. The relative PPO has been negative for almost the entirety of the last 3 years. This is not a good group. But if you don't follow relative strength, it looks like a great group, breaking out new highs. But even with this breakout, the last line turning back down again, this is not an area of strength. Now I'm going to go through these others much quicker. Semiconductors turning back up. Love that. We went below the 20-week moving average for the first time since back in August of 2019. And we came roaring right back. And look, just making a breakout on the absolute chart. So nothing wrong here with semiconductors. Software. This is a group that is still kind of floundering. You can see the relative PPO is negative. You look back over the last 3 years, we never went negative. Now we're just kind of hanging there, mostly going sideways. I really want to see this. We're starting to turn back up with this move in technology. I want to see technology break out, and I want to see software continuing to lead, because software has the capability of growing their earnings very rapidly. And that's why we saw the kind of price action on a relative basis that we did. So this would be very, very positive for technology if we start to see software breaking back out above the moving averages and get that relative PPO back in positive territory. Electronic equipment's been very strong, had this huge run ups, pulled back, a little consolidation, but I would not be giving up on the stocks in this area. I know one stock, Zebra Technologies, is one that's in this space. I think still looks very good. And I think Vuzi's in this space too. Vuzix, VUZI, which is in one of our portfolios. And that stock, incredibly volatile. Make sure you got some Pepto-Bismol if you're trading that stock. But it's been in a nice uptrend. I think the stock still looks good. But 20%, 30% moves up and down, no problem. I mean, that stock's been doing it now for months. Computer hardware made this big move all the way up until the summer of last year and tried to get through, couldn't, came back down, went negative. You can see the relative PPO. This is all a result of technology, struggling since February. And not only is it struggling, but computer hardware has been a very weak performer versus the S&P, but we're starting to turn back up again. Semiconductors got healthy. If computer hardware and software get healthy, again, on a relative basis, start turning up, that would bode very, very well for technology as we head through earnings season. Electrical components, very strong still, looks good down on the absolute chart. Look at this price action. Beauty. And then telecom equipment, been trending lower, did just move into positive territory here with this push, but the overall trend is down. I'm okay with the group, but I would be a little more concerned if we can't hold these moving averages, both the 20 and the 50. We got the 20 now turning back to the upside, but we saw this before. We didn't get through the relative 50-day moving average, 50-week moving average here, but we were turning up. The 20 started to turn up against the 50, and then everything fell apart again. So if it starts to roll back over again, we've got to be careful here. All right, next up, we're going to go into discretionary, and I'm going to go much quicker here. So we've got hotels, I think, looking strong. Toys, more consolidation. Watch this double bottom here. Restaurants and bars, I mean, the 20 and the 50 are almost right on top of each other. We've been going sideways, not really showing anything here just yet. But again, you look at the absolute chart and you say, wow, I'm in the best area in the market. Look at this, breaking out new highs. Look at the relative strength, and it's like, well, not really the best area of the market, just being lifted by the market. You got specialized consumer services trending lower, below the moving averages, PPO weakening, not a good looking chart there at all. Clothing accessories, kind of interesting because we're in an uptrend, came back, hit the 50 and starting to turn back up. Relative PPO at the center line. I think the next big move here is going to be really important on clothing and accessories. Do we continue making this bounce? I think we do. But if we don't, and we go back down below that 0.0925 level, that to me would be more of a bearish sign. on a relative basis. Doesn't mean the group won't go higher, but it just doesn't look like it would be a leader at that point. This is one of the strongest areas, or was one of the strongest areas in March. Home improvements made a lot of improvement on its chart, breaking back out above both moving averages. That was great action, and it also occurred with an absolute breakout. So I would look for this relative strength to continue. Home Depot has been on fire, and the AD line has gone straight up. I think there's a lot of accumulation taking place on Home Depot. Recreational services also moving higher, trending up. I think this group looks good for now, but it's also coming out of the basement. I mean, this was awful. Look at the relative drop. And so, yes, we have been strengthening, but it's almost like a relative dead cat bounce. We're nowhere near where we were back at the beginning of 2020. I mean, we're starting to get some decent news out, cruise lines and airlines, and well, airlines not part of this group, but cruise lines, which are part of the recreational services, starting to get a little bit better news, and that's helping. And certainly we're bouncing, but I wouldn't be surprised if we plateau here at some point and maybe go sideways for a while. It's still looking okay. I wouldn't be, afraid, but I would be a little more skeptical maybe of stocks within this space. Make sure I keep my stops in play. Apparel retailers trending higher, I think looks good. Specialty retail trying to come back. I'm going to talk about retailers and show their seasonality in just a minute. But specialty retailers sideways consolidating, but after a huge run up last year. So watch to see if we can get the breakout above this relative high in January. I think that would be bullish. Travel and tourism, I think this is one of the stronger areas in the market, continues to be. Maybe it's certainly the reopening is helping. The vaccine news came out in November, and we've been going straight up since. So this continues to be a very strong area of the market. Gambling, maybe not to the extent of recreational services, but it's making up a lot of this huge relative drop that it had back a little over a year ago during the pandemic. So it's making a run back, but this run is a little bit stronger than recreational services. So I still like gambling stocks here. Home builders trying to make a relative breakout, still looks good. And this is, last few months, think about what interest rates have been doing. And yet home construction leading the push to the upside. Think about what that's telling us. A lot of us are thinking, oh, interest rates going over that, that's going to, completely squash this economy. Well, home construction stocks aren't saying that. So I listen to the charts, not to the news. Broadline retail, this one's been under pressure, but starting to turn back up. Amazon starting to strengthen a little bit. That's a big part of broadline retail. So we'll have to see whether or not we can get back through the 20. It's going to rely on Amazon. Furnishings continue to be strong. Nice uptrend off of that March low on a relative basis. You can see absolute chart very strong as well. So this is a group that I'm fine investing in. Then you got footwear. Footwear has weakened, but it's coming back down close to this relative breakout. I think footwear is going to strengthen again. The chart's not necessarily saying that at this point. So maybe, it's just a little more intuition than it is charts, but I believe that we're going to see this group break out. I would watch the absolute price action because we're just consolidating here in the last few months. But I think if you see this line break back up above 2,600, 2,650, that's when I think you're going to see that relative strength line really start to strengthen again. Business training and employment agencies strengthening, looks good. Then you got durable household products breaking out to about a 2-year relative high, looks good. Automobiles, I mean, they've been weak on a relative basis, but my gosh, let's give them a break. This was the best area. This in renewable energy was the best area in 2020. So it's okay. I know a lot of folks writing Tesla off because they've got tunnel vision. They can only see the last 2 months on the chart. My gosh, Tesla has been the best performing stock in the stock market, or certainly one of them over the last year and a half. Can the stock pause? I mean, it's basing. I think Tesla is still one of the best stocks in the market. Recreational products, I think, continues to be pretty strong. Did break out to a new relative high just recently. I think that's good. And the last one, auto parts, continuing to trend higher. So you can see most of those groups, I think, still look pretty strong. And when you have the majority of groups within consumer discretionary looking good on a relative basis, it's hard for me to be bearish when the group breaks out to another new high. So I think consumer discretionary, um, I would go out on a limb and say I think it's still going to be the best performing sector for 2021. I just think there's so much pent up demand for consumer discretionary type items that I think some of these companies are going to really be blowing out some numbers. All right, couple earnings real quick here. RPM, they did come out and they beat top and bottom line. Let's get an update. Market just opened, so we'll see what the reaction is. Well, it opened down, but trying to move up now. It's really got to clear that November high. We've been consolidating here for a while, but we are moving up. We're trending above that 20-day. I would expect that 20-day to hold until we make this breakout. I think we are going to make the breakout. One other one we'll look at, actually two others. SMPL, this is the Simply Good Food Company. Sideways consolidating, stock up a little bit with its earnings. Not really anything special about this chart. AD line looks pretty good, even though price came back. You can see it's still going up. So I think maybe there's a little accumulation here. But again, a rising tide lifts all boats. I would expect the stock to move up. I just don't know if it'll be a relative winner. And then finally, I had talked, I think recently on one of my shows about Schnitzer Steel. Say that 5 times in a row fast. Schnitzer Steel Industries. And what I had talked about was they were going to report great numbers. I would have been shocked if they hadn't. They blew their numbers away. $1.51 in earnings. The market was looking for 99 cents. But the other thing I pointed out is a lot of this is priced in. So we got this huge earnings report and the stock is not breaking out. That bothers me a little bit. In fact, if the stock, over the next few days were to make its way back up 45, 46, I might be tempted to take my profit. I probably would be tempted to take my profit because now the news is out and we haven't gotten the breakout. So I would assume that it's not going to break out until it does. So I'd be tempted if I'm holding a stock like this that's been so strong. I mean, we're talking about a stock that was $20 in November when the vaccine news came out. Now it's 42. So it's more than doubled. Lots of good news built in. The good news is out now, and we're not able to break to a new high. We didn't get that gap up to create the breakout. So unless we get the buyers coming in during the day, and unless we see this stock really shooting up on some volume later today, I'd be a little careful with it in the near term. Not to say it's not good stock. In fact, if we get this thing back down 37.5, 38, that I think would be a better opportunity to re-enter. All right, 3 you must see. I'm going to start off with UPST. Upstart, the stock has been on fire. The one thing that always bothers me about these companies when they make these big moves is it's a great opportunity to reach out and raise cash. And so what did Upstart do after the close yesterday? Announced a 2 million share offering. So here is where we are with Upstart. Down 7% today, $10. Now, does this change anything? No, I think this is a great move by management. We just saw that with Vuzi recently. Stock was trading at 27 or 26. And they came out and had an offering at $20.50. So what did the price do of the stock? Went down to $20.50. Now it's back up to 28. So I expect we're going to see weakness, but probably going to be a buy at some point. I'd watch the 20-day, maybe this recent low, which is right about this prior high. 105 up to maybe that 120 level looks like an interesting zone. And on a stock like this, I'd be careful about picking out an area and say, well, I'm just going to give it $1 to the downside. This is way too volatile to be thinking I'm just going to give it $1. You're probably just going to get stopped out and you're going to lose $1. Instead, with a stock like this, I try to build a position and I start off slow, because if I happen to buy a little piece of this at the 20-day and it doesn't go down and fill my other orders, turns around off the 20 and goes back to 160. If I bought at 120, I don't need many shares to make some pretty good money. $40. Don't let greed get a hold of you on some of these stocks. Take your time, be patient, pick out your spots, and then be disciplined, because this is a stock that went up very fast. I would not want to be holding it if it goes all the way back down to 45. And I'm not saying that's where it's going. I just don't want to keep making excuses for it. It's easy to do. Oh, the 20-day, we lost that. Oh, but here's price support. Oh, we lost that. But then there's gap support and the 50-day. Oh, we lost that. Well, then, and then you get into a really deep loss. So the only thing I would say is figure out your strategy of getting into a stock like this beforehand and realize that it's incredibly volatile. It's a volatile stock. Next stock up, GEO. They suspended their quarterly dividend. I want you to look at this chart, which has just been going down, 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 80 line, down, down, down. The relative strength, it's been a horrible stock. It's in real estate, just keeps going down, down, down. Now, they suspended their quarterly dividend to maximize repayment of debt. Okay, well, we all know that dividends are not really on a percentage basis, it's not really a lot of money. To me, it's like taking a cup of water and trying to, put out a burning building. Look at the chart. I mean, this is all I need to see. I don't even ever want to be a part of this. How do you avoid being down 15% on a stock like this? Don't buy it in the first place. Wall Street is telling you it wants no part of it. And there's probably good reason. And we found one of those reasons today. So another reason just to pay attention to relative strength. If relative strength is horrible on a stock, look for a different stock in that space. If you really want a real estate stock, go find a good one that Wall Street likes. Don't try to find a bottom on a stock that Wall Street has no interest in whatsoever. And I mean, all the signs here are just beating you over the head. It's downtrending, AD line's horrible, relative strength line's horrible. Look at the group breaking out to a new 52-week high. And here this stock is just continually downtrending. Stay away from those stocks. Last one I want to show you, and I'm going to show you a seasonal chart. That'll be your final three you must see. And this is the seasonality of the retail ETF. And if we drag this all the way back, and I think I did it in a daily market report last couple of days. But if you look at the XRT, look, 80% of the time over the last 16 years, it's gone up in April. And its average April return is 4%, which is essentially double any other month. I mean, April is the month for retail. So knowing that should be a little part of your strategy as well. Knowing that retail is good. If I see a retail stock breaking out, I'm going to trust it more because it's occurring in a month where retail tends to do pretty well. All right, let's get a quick update and then we'll wrap this thing up. Currently, NASDAQ is definitely suffering on a relative basis, down 36. S&P up 5, Dow up 86. Let's see what that 10-year Treasury yield is doing. See if that's, 10-year Treasury yield's up 1 basis point. Not really anything. I think we're probably just seeing a little profit taking here in the NASDAQ because it has been leading of late. But overall, I think the overall market really looks strong. VIX continues to be under pressure, which is good. As that keeps dropping, that's just telling us fear is just slowly working its way out of the market, which is awesome. And that's one reason why I wasn't overly fearful to begin with, because everybody else is. So when the VIX is up in the 20s, the VIX is, I believe, later this year is going to work its way down to 10. We still got a long ways to go. And the VIX declining is synonymous with the S&P going higher. So I think we got lots of room to the downside on the VIX, which means we got lots of room to the upside on the S&P. All right, everybody have a great day. I'll be back tomorrow over at Stock Charts TV for the Thursday edition of Trading Places Live. Hope to see you there. That starts at 9 a.m. Eastern. Take care, everybody. Have a great day. Happy trading.